Today we are going to be looking at capital budgeting decision. All right. Uh, Under this topic, we have a lot to cover. However, we are going to discuss the introduction to capital budgeting decision. Okay. Then we are going to talk about the procedures, procedures involved in capital budgeting decision. Then we'll talk about the characteristics of capital budgeting, where we have major work is the discussion around method of project evaluation. This will last for an extended period. Okay. Then, of course, after this, then we have illustrations. Okay. We have illustrations. Okay, that will be that. So, as far as capital budgeting is concerned, we are going to spend about 4 periods for us to be able to do justice to the topic. All right. So let's pick it one after the other. Please, you can open to the study material at your end so that we follow through together. All right. So what do you understand by capital budgeting? All right. Capital budgeting is also known as capital investments or investment appraisal. Oftentimes, we also call it capital expenditure. All right. It involves the process by which an organization commits its funds into long-term projects, including construction of roads, dams, bridges, refinery, or office building. Any capital expenditure that will last for more than 1 year, all right, is referred to as capital investments or capital budgeting. All right. It is expected that management of a company will commit the limited scarce financial resources into projects that will increase the value of the company and which will invariably maximize the wealth of the owners using relevant investment appraisal technique. All right, because this financial resources is limited, then the company must ensure that the finance available is judiciously used, all right, in order to enhance the shareholders' equity value, all right? So that's the introduction to capital budgeting. What are the procedures involved in capital budgeting decision? Basically, there are about 6 steps that you may likely carry out anytime you want to um, embark on capital budgeting decision. The first step is identification of uh, possible project or investments. All right, identification of possible projects or investments. Number 2, evaluation of projects. That's number 2. Then number 3, authorization and approval of projects. Number 4, development and execution of projects. Number 5 steps. Number 5 step is monitoring and controlling of projects. And the last step, which is step number 6, is post-completion investigation or audit. Now let's talk about each step. The first one says identification of possible investment or projects. All right. So at this level, this this is the stage that a responsible person within the organization will need to scan the business environment to be able to identify any investable opportunities. Usually, in an ideal organization, it may well be that is the marketing department or R&D department or business service unit within the organization that will be responsible to scan the business environment to be able to identify any investable opportunity. There are a whole lot of activity that will go into doing that, but of course, this is just theoretical. I don't want to deep into uh, all the things that you need to do by identifying the investable opportunity. So what this simply means is that this step one, you scan when there is need. Say, for example, a company that wants to, maybe a company is currently using or the company is currently operating from a rented office. So the company is now contemplating on uh, constructing or building his own office building. All right. Okay, having his own office building. So as a result, you can't just say because you have so much financial resources and then you just do it anyhow. So you must first of all identify areas in which you can site your office. Of course, you also need to consider nearness or the kind of accessibility, nearness to your customer, where you think that your customer are common, okay, so that you can easily be accessible. All right. So there are so many things that you need to factor in when you are doing that. But again, so this is just to give you an idea of what identification of possible projects is all about. Then the second one, which is evaluation of projects. Now, at this stage, this is where you have responsibility as a finance person, whether you are a financial accountant, financial analyst, finance supervisor, or manager, or chief finance director, or chief financial officer. All right, this is where you have responsibility because this is your department. All right, this is your department. The fact that of course, in that step one, the head of the units that are responsible for scanning the business environment, we need to get back to the management of the upshots or about their findings. All right. To be in two folds. The first area is to meet with the management in a meeting. When in a management meeting, they will discuss the outcome of their findings. And then, of course, it also needs to be documented. It's not enough for you to just present your report to the management in a meeting. You also need to document it so that it's in black and white. Then at that meeting, the head of the finance department will be like either finance director or CFO or finance manager, depending on the size of the organization, will be required to go ahead and evaluate the project because the fact that you have so much surplus funds does not mean that you can just commit it into any opportunity, any investment opportunity. You need to appraise it. You need to evaluate to be sure that the project is financially viable. All right. So again, after the evaluation of the investable opportunity, then if it is financially viable, the finance director we need to get back to the management about the outcome of the analysis. Also, if it is not financially viable, it is still the same thing. Management must be aware. However, if the evaluation is positive, that is, if the project is financially viable, then it should be recommended that the project should be undertaken. So at that point, the management will need to give a no exemption taking for the project to commence. So, of course, once there is management, when there is authorization and approval to incur expenditure, then in that case, At this point, you will need to mobilize people and equipment to site. So that will take us to step 4, all right? Because there is authorization, there is also approval from the management. That means you have authority to spend money, all right? So once there's an approval, of course, like I said, a whole lot of activity, all these activities or stages, they are interrelated, all right? Because before you mobilize people and equipment to sites, depending on the size of the organization, the every organization we have what we call a capital budgeting policy or guideline, all right, that will dictate the how the company is expected to carry out their capital budgeting activities, all right, including the responsible parties and stakeholders in relation to the capital budgeting. Now, of course, even within the organization, there's what we call a uh, bid committee, capital budgeting committee, a kind of, that will be in charge of sourcing for contractor that will do the job, how to appraise each candidate or each vendor that will do the job, and then at the end of the day, the final decision will be taken on who is most qualified to execute the contract. All right. So contract agreements will be developed and then it will be signed by the two parties, both the company as well as the contractor. But again, I don't want to go into details as far as that one is concerned. But the bottom line is that once the contractor has been selected, of course, the company with the capital budgeting guideline will dictate whether is a single sourcing kind of contract. Maybe you want to give it to just one contractor, or multiple contractors will bid for the job, and at the end of the day, we select anyone that we think is the most qualified to do the job. But again, I don't want us to go into that. Then have at this point, when you now get to step 4, of course, the project will need to begin, because this is the procedure. I mean, this is the step where you commence execution of the project. So at this point, the company will need to mobilize people and equipment. Of course, it may well be that the payment will be made installments depending on the project activity, because it's the project activity that will be driving the spend. All right. So after you have mobilized people and equipment to start, then you need to monitor and control the activity of the people and equipment on site. Monitoring in the sense that, there are people working on site. Contractor has quoted in the contract that they are going to need so much quantity of material, for example, and there's so much number of laborers that will do the job. It's the responsibility of the company to provide its own representative on site to monitor the activity of the contractors on site. Because if that is not done, then of course an average contractor will always like to maximize his or her own margin. All right. So as a result, they will always want to follow shortcuts. So as a company, as a responsible company for that matter, you have responsibility to monitor the activity of the contractor on site to ensure that the right quality and quantity of materials are used all throughout the period of the project. Not only that, the contractors will have equipment on site. There will be people working on the project. You also need to monitor their activity to ensure their safety, and then you secure the equipment on site. Because if anything goes wrong, then the company may be held liable for that. Then, of course, the other part, which is controlling, this one is talking about controlling your cost as a company, all right? Because the financial resources is limited, it's not sufficient. Then the little you have to use it judiciously. So to ensure that you are getting value for your money, you must control your cost. You want to ensure that you don't go above your budget. If you go below your budget, if you spend below your budget, that's positive. all right? Provided you are having the same quality, the contractor is doing the same, I mean, giving the same quality as quoted in the contract. However, by monitoring your costs, you need to compare it. And also, you as a finance person, you also have responsibility here because you are the one that will be providing the project cost. All right, the project status, the spend, and like a stewardship kind of a report in relation to the project. So you need to compare the actual spend versus the budget, the budgeted figure. So are we spending above our budget or below our budget? Do we need how much do we need in the next 1 month, in the next 3 months, in the next 6 months, in the next 1 year? How much are we going to need to carry out some activity of the project? All of this, you are the one that will be doing the analysis as a finance person embedded in the project, okay? And not only that, at times it is possible that due to one reason or the other, you may want to spend more, you may likely go above your budget. If you want to go because you are monitoring your costs every now and then. So before the time that you are going to need, you would have informed the management, because on a regular basis, periodically, management must be aware of the project status. All right, where are we today? How much you have spent today? What are the activities that are driving the car? And this is where, as a finance person, all right, embedded in the project, you don't just say because you are a finance person, you are just crunching number every now and then. You need to relate with other project stakeholders, like the project team, project manager, for example, all right, to know about the updates of each of the projects, all right. What are the activities that they are currently carrying on? So because as they are coming to you that they need this, they need that, so you must also relay with them. You ask questions, you ask pertinent questions. You don't just be anything that comes to you is what you are just taking. You need to ask questions so that you'll be able to talk through the numbers, because you are just going to be a watered or an ordinary accountant. If you are just projecting numbers, then you allow the project manager to be your other project team to be talk. You must be able to talk through the numbers. So it is only when you drive there. In fact, if possible, occasionally you go to the site to go and observe how things are being done, because you can't just be spending money without going to the site to see the project activities. What are they doing? So each stage of the project, you have to visit the site to see things yourself, so that the project team are not just giving information, you are seeing it live and direct, so that you'll be able to monitor the activity from day one, from the beginning up to the end, so that you are well aware about the project. All right. So that's as per monitoring and controlling. And then again, in addition to that, because like I was trying to say the other time, it is possible that due to one reason or the other, you may need additional funding. All right. So which may push your budget above the approval level. So before that is done, it may well be that is a higher level, a higher level within the organization that will do the additional funding required. So every project manager usually they avoid that. They don't want to go above their initial approval to go and seek for funding, depending on the size of the organization though. But this may not be within the power or the control of the project manager or the project team, all right, or the project manager, because it is possible. But the bottom line is that you just have to give justification. If you are going above your budget, why do you want to go above your budget? Because every variance between budget and the actual spend must be justified. All right. It may well be that there will be an extension of time. All right. Because anytime there's an extension of time, there's likelihood that additional costs will be incurred. Look at what happened in 2020 during COVID-19. Nobody saw it coming, right? Nobody saw it coming. So, and then it just, in fact, it affected everybody in the entire world, such that the whole world was under lockdown for an extended period, over 4 months, almost 6 months or thereabout. So you can imagine if there are project activity going on during that period. And because it is shut, activities are shut down, you cannot operate because of COVID-19. All right. So that will involve after the restriction was lifted, of course. So you have to recover all the time that you have lost. So that will extend the period. So there will be an extension of time. So once there's extension of time, certainly there will be additional cost that will be incurred. So again, it may well be that there's a change in scope in the project. If there's a change in scope, say for example, something that you don't have that is not quoted in the project before, you now introduce it, you now want to do it. So when that happens, of course, say for example, there's a technological enhancement that you want to embed in the project. So when that happens, so it will increase the cost of the project. Again, another area of change in scope is that, say, for example, something you have included in the project before, now you don't think that thing is necessary again. So you remove it. Once you reduce the scope, then your cost will also be lower. So give and take. At any time you have a budget variance, okay, that is the actual when there's a difference between the budgeted figure and the actual spend, certainly you need to provide justification for the variance. And as a finance person, you need to relate with the project team to be able to know what is driving the cost, because from day one to the end, the project duration is the activity that will be driving it, including cost. Because say, for example, from year 1 to year 5, let's say the project will have duration of 5 years to complete. So each is not that you are just going to divide the cost of the project by 5 years. It doesn't work that way. It's the activity that will be driving the cost, because each activity has different costs. So, and that's why you need to work with the project team to know the status of the project so that you will know what is the driver of the spend. What's the driver of the spend? All right. So that's as per monitoring and controlling. And then the last one is the post-completion investigation or audit. At this level or at this stage, management wants to ensure that the objective at which the project is being executed has been achieved. All right. So it may also be that, okay, there's a defect in the areas or in the aspect of the job done by the contractor. In this case, you need to call the contractor to come and fix it. And that's why in every contract, okay, you have a retention fee. Retention fee is just a specific percentage of the contract price that is retained until the company is satisfied of the job done, of the quality of job done. All right. Because if you have advanced the entire 100% of the contract price to the contractor, and after a month or thereabouts, you now discover that there's a defect somewhere in the job done. If you call the contractor, the motivation will not be there to come back. If the contractor is going to come back, the contractor may delay. All right. But if the contractor is aware of the fact that he still has some money to collect from you, certainly, hey, they want to come. All right. They want to come. Not only that, as far as this post-completion investigation is concerned, it is, of course, when you are executing the project, when you are developing the project, there will be lessons learned, all right? There will be mistakes. So those mistakes will be corrected, and then the lessons learned will need to be documented so that in the future, you don't repeat similar mistake. And the essence of documenting these lessons learned is to aid organizational learning, because even the project manager that did the first job might have left the organization or is not available again. Maybe you have a new manager. So since you have documented the lessons learned, then you can easily go back to your archive or whatever, wherever it has been saved. Go there, listen, whether it's a video document that you can go through, so to learn about what was done previously. Just like you have, when you are new in a particular environment, on a particular job, so you walk through the handover notes and all of that for you to be able to know more about the new role. All right. So this is basically about the procedures involved in capital budgeting decision. All right, the next thing we want to talk about is the characteristics of capital budgeting. What are the characteristics of capital budgeting? The one is that it involves huge capital outlay. All right, capital budgeting activities involve huge capital outlay, even if it's going to be your own owner-occupier building. Say, for example, you want to erect your own residential building. Of course, you can see in today's price is millions, not to talk about high-rise building, all right, maybe 10-story building or 20-story building and all of that. Is a whole lot of investment, all right? So usually it involves huge, a very significant capital outlay, all right? Then the second one is that the benefit will accrue over a long period, all right? Benefit will accrue over a long period. So at the beginning of the when the project is being developed, all right, the company will just be spending money. It will be cash outflow, cash outflow. But once the project is completed, the company will now begin the project will begin to generate cash inflow. All right. At that point in time, that cash inflow will continue for the foreseeable future. All right. Okay. Provided the project is still operating, the company will continue to benefit it. And that's why we are saying that the benefits associated with the project will accrue over a long period. All right. Then the third one is that uh, it is considered to be highly risky. Okay, it's considered to be highly risky. Capital budgeting is considered to be highly risky. Risky in the sense that it is not certain that the company is going to recoup or is going to earn the targeted return on investment. You know, before you embark on any project, your intention is not that project that you want to embark upon is not just for the fun of it. There's something, there is a goal that you want to achieve. All right. So it is possible that this project may result to financial losses to the organization. So that's why we are saying that it is considered to be very risky. All right. So you may anticipate that we are going to earn 30% return on your investment. You may not achieve that 30%, maybe lower, maybe 20, maybe 10. All right. So it is also possible that the project you can even lose your entire investment. All right. A company can lose its entire investment on the project. All right. So that's why we are saying that it is considered to be highly risky. You recall that for those of you that live in Lagos, you know, sometime in 2022, there was an incident that happened in Ikoyi. We call it Ikoyi Gate as at that time. A building, a skyscraper that collapsed in February 2022 around Ikoyi, you know, the incidents that about almost 50 people lost their lives, all right, as a result of that. You know, why did the building collapse? All right, because Lagos State government gave an approval for 15th floor high-rise building, and then the contractor, with the connivance of some government officials, they extend the floor to 21 from 15. They extended it to 21, and the building gave in. And so on this fateful day, you know, there are artisans like carpenters, bricklayer, all sort of artisans, including youth corpers that are currently that were working on the contract on the project on that fateful day. In fact, the owner of the building was also there at the site. In fact, his friend that just came to Nigeria to do one or two things. The guy was on his way back to his base in abroad. He just said, "Okay, let me say hello to my friend." And both of them, where they were talking, the building collapsed on them, all of them. You know, so that is the money that was used the money that was used to construct that building is my money, your money that we kept in the bank, because most of those kind of projects are based, I mean, are funded by loan. All right. It's true borrowing. So the money you kept in the bank, the money I kept in the banks. So you can see it's a that's why we are saying that it's considered to be highly risky, because you can lose money as a result of that. That is by the way. So also, another characteristic that you need to consider is that the capital budgeting involves irreversible decision, all right? It involves irreversible decision, meaning that because there's contract agreements between the two parties, between the company and the contractor. So none of the party can rescind their decision to say that, okay, I'm not doing again. Well, because if you say you are not going to, you want to withdraw from the contract, that means it's not going to come for free. You must be able to pay whatever compensation that will arise from your decision to reverse our initial agreement. If the company, for example, is saying that maybe because of one reason or the other, okay, contractor, stop work, we are not doing again. The contractor will tell you that, CEO, I've mobilized equipment to site, borrow loan with interest, and then this is how much you are going to pay me. If you say you are not going to do it again, then you have to compensate me. If the company is not willing to pay, then there will be litigation. Once there's litigation, then the reputation of the company can be impaired. All right? That can damage the image of the company, and then you have to guard against that. Okay? And that's why before you commence, you must ensure that you are ready and willing to go. All right. So those are the features of capital budgeting. Now let's talk about capital budgeting evaluation method or method of project evaluation. Like I said, this is where we have major work. This is where we have major work. This will last for an extended period, dissecting the concepts. All right, under this. So before I proceed, let me know, some people are sending messages. Let me know if you have any question for me. Somebody, Sarah Sarat is asking, what topic is this? It's capital budgeting or capital investment decision. Okay, somebody has answered already. Thank you. All right then. So let me know if you have any question for me. If not, just continue. All right. So what are the methods of project evaluation? Basically, there are two methods of project evaluation. One is discounted cash flow method. Two is non-discounted cash flow method. What do you mean by discounted cash flow method? The discounted cash flow method is a method that consider the timing of cash flow and the time value of money. I take it again. Discounted cash flow method is a method that consider the timing of cash flow and the time value of money. The time value of money connotes that the value of 1 naira of today is worth more than the value of 1 naira tomorrow due to price level changes or investors' preference to have their benefit now. When there is inflation, the purchasing power of money will fall. Therefore, some investors, they prefer to have their benefit now. Don't delay it to tomorrow. Give it to me now so that I can use it to do whatever I want to do with it to earn my value. All right. So that's basically discounted cash flow method. All right. So under this, the techniques under the discounted cash flow method include the net present value, the internal rate of return, modified internal rate of return, adjusted present value, discounted, let me put it this here, discounted payback period. Okay, discounted payback period. Then we also have project duration. Project duration. Okay, these are some of the techniques under the discounted cash flow method. Okay. Of course, we also have profitability index, especially when you get to capital rationing. Again, capital rationing is taken out of the SFM syllabus. All right, you can call it profitability index or benefit cost ratio. Benefit cost ratio. Okay, so that is basically the discounted cash flow method. The non-discounted cash flow method is also known as traditional method of project evaluation. Is a method that does not consider the timing of cash flow and then the time value of money. All right. So, what are the techniques under the non-discounted cash flow method? Number one technique is payback period. Then two, accounting rate of return. All right. So that's that. Let's talk about our approach will be that we are going to focus on the discounted cash flow method first. Then once we are done with with dissecting the techniques under the discounted cash flow, then we now talk about the non-discounted. So we are starting with net present value. Okay, what do you mean by net present value? The net present value represents the difference between the present value of cash inflow and present value of cash outflow in capital investment. I take it again. The NPV represents the difference between the present value of cash inflow and present value of cash outflow in capital investment. The NPV criterion is adjudged to be the overall investment appraisal technique, all right, of course, in theory, all right? So it's considered to be the overall investment appraisal technique because a positive NPV is expected to increase the value of the company and which will invariably maximize the shareholders' equity value. All right, because NPV is consistent with the shareholders' wealth maximization objective, and that's why it is considered to be the overall investment appraiser technique. Now, of course, I can't be at this level, examiner cannot be asking you what are the advantages and disadvantages. All right. So examiner will not be asking you all of that. But again, it's good to know. It's good to know. All right. So, yeah. So try as much as possible to the read about the advantages and the disadvantages of NPV. Even though examiner cannot be asking you at this level, but again, it's good to know just in case examiner might want to give you a bonus. All right. So if you don't know, you don't know. No matter how easily something, if you don't know it, you don't know it. All right. So uh, try as much as possible to read the advantages and disadvantages. Now, how do you estimate net present value? How do you calculate net present value? There are two ways you can calculate NPV. You can either use formula or you use tabular method. Whichever one you use, you are expected to get the same answer, except with rounding error. All right. So say, for example, I want to use formula to calculate NPV. Of course, from the definition of NPV, we said that net present value represents the difference between the present value of cash inflow and the present value of cash outflow in capital investments. All right. So how do you then determine the present value of cash inflow using formula? To do this, the present value of cash inflow, to calculate the present value of cash inflow, you pick the cash flow for each year. Let's say cash flow of year one divided by the discount factor of year one plus cash inflow of year two divided by discount factor of year two. So it will continue like that until the final year. Then you pick the cash flow of the final year, you discount it, we divide it with the discount factor of the final year. So this will give you the present value of cash inflow. then you now less the present value of cash outflow. This will give you the net present value if you are using formula. All right. Of course, the tabular method of calculating the NPV, we have done it severally when we had the cost of capital. All right. So it's the same thing. Okay. Just to add this one. Okay. Now, what are the decision rule? Before we move to the decision rule, you know that when you want to calculate discount factor, you know the formula already. This is the formula for calculating discount factor. It's also possible that you may want to determine discount factor or annuity factor to infinity. Before that, let me see. Yes, this is annuity factor here. You're already familiar with this formula. We use it also when we had cost of capital. But let's say you want to calculate annuity factor to infinity, all right? Annuity factor to infinity. How do you do it? The annuity factor to infinity, of course, is calculated as 1 divided by R. It's the same thing as what you have here, okay? 1 divided by R. Let's say, for example, of course, R is the company cost of capital. Let's say cost of capital is 10%. Okay, cost of capital is 10%. You just say 1 divided by 0.10. So this will give us like a 10. Okay, that will give us like 10. So that's whenever you want to determine annuity factor to infinity. So that's the formula you are supposed to use. But what if you want to determine present value to infinity? If you want to calculate present value to infinity, it will be A divided by R, where A is the cash flow, R is the cost of capital. Let's say, for example, you want to calculate present value to infinity, and A, which is cash flow, is 5,000. You have cash flow of 5,000 naira, all right? And then the cost of capital given to you is 10%, okay? So I will just say 5,000 divided by R is 10%, so 0.10. So whatever you have, you put it there. So that will give you the annuity factor of year 1 to infinity. Annuity factor of year 1 to infinity. This one will be 5,000 divided by 0.1. That should give us the 50,000. All right, this will give us 50,000. That's it. So this is how to calculate value to infinity. Now, yes, what are the decision rule in relation to, this is the tabular method I was talking about the other time, which we did under cost of capital. What are the decision rule under NPV? What are the decision rule for independent projects? For independent projects, accept if NPV is positive. Provided you have a positive NPV, the project is financially viable. But if the project produces a negative NPV, it means it is not financially viable. Therefore, the company should not consider it, should not undertake it. So that's just the decision rule. What if you have 0 NPV? So you calculate the present value of cash inflow and then the present value of cash outflow. You now get 0. That means the company can either accept the project or reject it, depending on other qualitative factors. All right. So that is independent projects. What if you are given mutually exclusive projects? Under mutually exclusive projects, you accept any project with a higher positive NPV. That's the decision rule. Where there are mutually exclusive projects, accept any project with a higher positive NPV. Let's say, for example, you have project A. If project A and B are mutually exclusive, and then you have calculated NPV for each of the projects. Let's say NPV of project A is 15 million. NPV of project B is 12 million. Because the two of them has positive NPV, for project A with a higher positive NPV will be considered. Project B will not be undertaken. That's the implication. All right. So that is mutually exclusive decision rule under mutually exclusive project. Now, what do you understand by independent projects or mutually exclusive projects? The independent project is a standalone project that can be accepted or rejected depending on his based on his own merits. Okay, independent projects is a standalone project that may be accepted or rejected based on its own merits, which means that as independent projects, if the project produces a positive NPV, for example, it will be accepted. But if the project generates a negative NPV, it will not be accepted. So that is independent project. The second one is mutually exclusive projects. A mutually exclusive projects are competing projects in which the acceptance of one will preclude the acceptance of the other. For example, in my analysis here, in my example here, for example, if project A and B are mutually exclusive, the acceptance of project A will mean that project B will be rejected. On the other hand, if project B is accepted, project A will be rejected. That is mutually exclusive project. Mutually exclusive projects are projects that cannot be accepted together. Either of the two will need to be accepted. You cannot do the two together. That is mutually exclusive. All right. So we are done with NPV. Let's move to internal rate of return. Let's talk about internal rate of return. The internal rate of return is also known as break-even rate, yield to maturity, or market discount rates. All right, is the rate that equates the present value of future cash flows to zero. All right, any rate that you use to calculate NPV and produce zero NPV, that rate is the internal rate of return. Okay, the IRR relies heavily on trial and error method. IRR relies heavily on trial and error method in calculating NPV. All right. So basically, whenever you want to calculate internal rate of return, there are three procedures you are supposed to carry out. The first procedure is to assume two discount rates that will produce two opposing NPV. All right. Step one, you assume two discount rates. All right. Assume two discount rates that will produce two opposing NPV. Okay. That will produce two opposing net present value. That is a positive NPV and negative NPV. That's what I mean by two opposing NPV. That's step one. Then step two, of course, when you assume the two discount rate, you are supposed to use it to compute your NPV. All right. Then step two, you calculate the internal rate of return. Okay. Calculate internal rate of return using the IRR formula. Okay. This is the IRR formula here. That's the formula you are supposed to use. A is the lower discount rate, B is the higher discount rate. We have done this, we used this during the time when we had the cost of capital. Then step three, you advise on the acceptability of the project using the internal rate of return. Okay, so again, you need to read the advantages and disadvantages of internal rate of return. Okay, read it. Now, what are the decision rules for internal rate of return? What are the decision rules for independent projects? Accept if the calculated IRR is higher than the company's cost of capital, okay? Accept if the calculated IRR is higher than the company cost of capital. That's the decision rule for IRR, where you have independent projects. Then 2, for mutually exclusive projects, accept any project with a higher IRR, provided it is greater than the company cost of capital. I repeat, for mutually exclusive projects, accept any project with a higher IRR, provided it is greater than the company cost of capital. So that's the decision rule as far as internal rate of return is concerned. When you want to make a decision under internal rate of return, you are supposed to benchmark, you are supposed to compare, all right, your calculated IRR. Your calculated IRR is what you use, whatever you arrive at when you use this formula, that's your calculated IRR. Then you now benchmark it against the company cost of capital. So that is internal rate of return. Okay. The good thing about capital budgeting is that majority of you have done it under performance management before you cross to professional level, except that if you jump fence. Yes, if you don't jump fence, you would have done this in the past. In any case, so you have to, I expect you to assume zero knowledge. All right. Even if you jump fence, just assume zero knowledge that you have not done it before. When I say you jump fence, those those students that attended some institutions that have mutual agreement with ICAN, so they are the ones that normally jump fence because they will not write skills, they will not write foundation and skills level. They are credited from that. They are exempted from writing foundation and skills level. So they just start from professional level. All right. So they jump fence. So yeah, let's move on. Yes, let's talk about areas of conflicts between NPV and then internal rate of return. Areas of conflicts between NPV and internal rate of return. Okay. Oftentimes, the decision of NPV may be conflicting with the decision of internal rate of return. This usually arises where there are mutually exclusive projects. Okay, so when there are mutually exclusive projects, NPV may accept a particular project while internal rate of return will favor another project. So when this happens, of course, that's an apparent conflict between the two techniques. Therefore, examiner can ask you, what are the causes of conflict between NPV and then internal rate of return? 2, how do you resolve the conflicts? All right, so you need to know what you're supposed to do. Okay, now, what are the major causes of conflict between NPV and then the internal rate of return? There are three key reasons for conflict. I will use hypothetical figures to explain this. Let me look for space. Yes. Let's say, for example, we have two mutually exclusive projects, project A, project B. All right. So let's say the initial outlay of project A is 500 million. Initial outlay of project B is 800 million. Okay. Let's say the useful life. The useful life of project A is 3 years. Year 1, year 2, year 3. Then let's say the useful life for project B is 5 years. Year 1, 2, 3, 4, and then 5. We also assume that the cash inflow generated by project A in the first year is 300 million. Cash inflow in year 2 for project A is 250. In year 3 is 150. Of course, the useful life for project A is 3 years. Then let's assume that the cash inflow generated by project B in the first year is 100 million. In the second year is 180. In the third year is 200. In the fourth year, 300. And in the fifth year is 350. All right. For example, let's say we have discount factor at 10%. And you know that discount factor for year 0 is usually 1. At 10%, discount factor of year 1 is 0.909, 0.826, 0.751, 0.683, and then 0.621. 0.621. Now, we want to use these hypothetical figures to explain the major causes of conflict between NPV and then internal rate of return criterion. Now, the first cause of conflicts between NPV and internal rate of return is when there is significant difference in amount of capital outlay. All right. When there is huge difference between the initial outlay of the two mutually exclusive projects, that can result to conflict between the decision of NPV and the decision of internal rate of return. Conflict in the sense that NPV may accept a project A, and then internal rate of return will suggest that project B should be selected. So that's an apparent conflict. Okay. So whenever there is significant difference in the amount of capital outlay, that can result to conflict between the two decisions. The second cause of conflict is when there is difference in pattern of cash flows, all right? Pattern of cash inflows, all right? So for example, when you look at project A, all right? Project A has a higher cash inflow at the earlier part of the project. At the latter part, the project generated a lower cash inflow relative to project B that has a lower cash inflow at the earlier part, then at the latter part, it has a higher cash inflow. You know that when you want to determine present value of projects, discount factor at the earlier part is always higher. Like for example, this 10% we assume. You notice that in year 1, discount factor at 10% is 0.909. In year 5, discount factor is 0.621. So at the earlier part of a project, discount factor is always higher. So any project with a higher positive NPV will generate a higher present value at the earlier part. So when you have this kind of pattern of cash flows, certainly there will be conflict between decision of NPV and then the decision of internal rate of return. The third major cause of conflict between NPV and internal rate of return is when there is difference in project sizes or useful life of projects. Okay, when you look at these two hypothetical projects, you notice that project A has 3 years life. All right, project A has 3 years life, while project B has 5 years life. The project that has additional 2 years, project B that has additional 2 years has opportunity to recoup, to recover more cash inflows. All right. So project B may be favored over project A as a result of that. So whenever there is difference in useful life or project sizes, certainly then that may result to conflict between decision of NPV and then the internal rate of return. Okay. So you can just, this is what I just explained is what you have here. So you can go through it and understand better. Now, examiner can ask you, how do you resolve the conflicts between the two techniques? How do you resolve the conflicts between NPV and then the internal rate of return? When choosing between two mutually exclusive projects, your decision should be based on NPV at all time. All right. Always, your decision should be based on NPV. Why? Because a positive NPV we increase the value of the business, and which will invariably maximize the wealth of the owners. The NPV technique is an absolute measure of profitability or return, all right? And then it's a technique that is consistent or that is in consonant with the shareholders' wealth maximization objective. And that's why NPV is superior to any other techniques, all right? Irrespective, whether it is internal rate of return, modified internal rate of return, adjusted present, whatever the techniques, NPV is superior to it in theory, not in practice. Okay, so in theory, NPV is superior to any technique. And that's why anytime you want to, in your exam, if the examiner is asking you to evaluate, there's no other technique they're asking you to calculate for other than the NPV, except examiner is specific by telling you that, okay, use a particular technique. Other than that, it has to be NPV, all true, because NPV is a technique that is consistent with the shareholders' wealth maximization objective. And you know that the primary purpose of any profit-making organization is to enhance the value of the owners. So NPV, even if a project give you a 1 naira NPV, that means the wealth of the owners will also increase by 1 naira. All right. So that is how to resolve the conflict. All right. To resolve, I repeat again, to resolve the conflict between NPV and the internal rate of return, your decision should be based on the NPV, because NPV is a technique that is consistent with the shareholders' worth maximization objective, and is a measure of profitability. Okay, it's a measure of profitability. All right, so that's that as per the areas of conflict between NPV and then the internal rate of return. So you can also read these aspects. I'll just summarize it for you. So yes, so like I said, the NPV criterion is more reliable relative to the internal rate of return in ranking usually exclusive projects. So that's that. Under the discounted cash flow method, we just discussed the net present value and then the internal rate of return. Let's talk about modified internal rate of return. Before I go into that, let me know whether you have any question for me. Just raise your hand. I will allow you to talk. But if not, let me just go ahead and do the explanation of the concept. Okay, let's talk about modified internal rate of return. You have to pay particular attention to this aspect, because the capital budgeting, for some of you, the capital budgeting that you did under performance management, you did not do modified internal rate of return. So it's new. All right. So you need to pay attention. So what do you understand by modified internal rate of return? You know, when there are unconventional cash flows, when you say unconventional cash flow, what we simply means is that it is possible. Let's say, for example, we have year 1, year 2, and then year 3. When you have a mix of negative and positive cash flows, so that means they are unconventional. A conventional cash flow is a cash flow in which you have positive cash flow all throughout, where you have positive cash flow all throughout. But when you have a mix of positive and negative cash flow, that is very unconventional. Let's say, for example, in year 1, okay, cash flow in year 1 is 5,000. Cash flow in year 2 is 500 negative. Cash flow in year 3 is 1,000. So when you have a mix of positive and negative cash flow, that means it is unconventional cash flow. All right, these are unconventional cash flow. So when there are unconventional cash flow, it is not appropriate to use the internal rate of return as a decision criterion, all right, as a decision criterion, because it will conflict with the decision of the NPV, and as a result, it will not be in line, it will not be consistent with the shareholders' wealth maximization objective. Okay, so generally, the assumption behind NPV is that the cash flow generated by projects can be reinvested at the company cost of capital. However, the internal rate of return is saying that no, the cash flow generated by a project should be reinvested elsewhere at the internal rate of return. So again, this is an apparent conflict. How could internal rate of return be always be conflicting with NPV? That means IRR must be a very stubborn technique, because any discount rate that is not consistent with the shareholders' worth is not a suitable one. Of course, like I mentioned earlier today, the primary purpose of any profit-making organization is to enhance the value of the owner. You want to increase the shareholders' worth. So if, as a technique, you are not consistent with the shareholders' worth, that means that technique is not suitable. Okay? That technique is not suitable. So like I said, the assumption behind NPV is that the cash flow generated by a project can always be reinvested at the company's cost of capital. But IRR is saying that no, the cash flow generated by a project should be reinvested elsewhere at the internal rate of return. And that is why the modified internal rate of return was developed. Okay? The modified internal rate of return was developed to correct the anomalies associated with the internal rate of return. So the modified internal rate of return will allow the decision maker to specify a reinvestment rate to be used for the project, a reinvestment rate to be used to evaluate the project. All right, because the modified internal rate of return has been adjusted to and is consistent with the NPV such that the cash flow generated by the project can be reinvested at the reinvestment rates or at the company cost of capital. All right. So that is basically the modified internal rate of return. Okay. Now, how do you compute modified internal rate of return? How do you calculate modified internal rate of return? Let's do it this way. I need space. Let me clean up this so that I can explain to you in details how to calculate modified internal rate of return. Now, basically, there are two different methods that can be used to calculate modified internal rate of return. Okay, you can either use terminal value method. Let me put it down. Methods of calculating modified internal rate of return. Okay, the first method is to use terminal value. You can use terminal value method. Or two, you use present value method. So whichever of the method that you use, you are going to get the same answer. So I will explain each of them and what you need to do. Let's talk about the terminal value. Okay. Terminal value method. All right. Now, this is a method that relies heavily on the positive cash flows. All right. This is a method that relies heavily on positive. Let me put it down for you. This is a method that relies heavily on positive cash flows. Okay. It involves the following procedures. It involves the following steps. So whenever you want to calculate modified internal rate of return using terminal value method, There are 3 or 4 procedures that you are going to carry out. The first step is to calculate terminal value for each calculate terminal value for each positive cash flows. So step 1, calculate. Let me break it down for you. Calculate terminal value for all positive cash flows. Positive cash flow is the same thing as cash inflow. For all positive cash flows. Then step 2, calculate. Okay, calculate present value for negative cash flows. All right. Then step 3, calculate terminal value. Sorry, calculate modified internal rate of return. Calculate modified internal rate of return using the formula below. Okay. Of course, it's the same formula you have up there. So you just say modified internal rate of return is calculated as the terminal value divided by present value of cash outflow, all raised to power 1 divided by n, all minus 1. Let me write that. What's wrong with you? Don't start to. Okay, all minus 1. Then you multiply by 100 over 1. So this is the formula for calculating modified internal rate of return using the terminal value method. The first thing first is to calculate the terminal value for all positive cash flows. Step 2, you estimate the present value of negative cash flows. Then step 3, you calculate modified internal rate of return. Of course, step 4, you need to advise. So we do the advice later on. Okay. Now, how do you then calculate the terminal value? Let me see if I can get additional space just to, okay, let's use here. Now, the same way you normally calculate NPV is the same way you, or let me say, the same way you calculate present value is the same way you are going to calculate terminal value. The only difference is that, when you are calculating present value, you don't include year 0, but you are supposed to discount the future cash flow to get, you multiply the cash inflow with the discount factor to get the present value. However, when you are calculating terminal value, you don't discount, rather you compound the cash flows. All right, you are supposed to increase you are compounding the cash flows. All right, it's like you are growing the cash flows, and that's why you are calculating terminal value. So let me give you the format. Okay, format for calculating terminal value. Okay, let me give you these hypothetical figures. Let's say, for example, this project has 3 years life, and then there are cash inflows. There are cash inflows for the project for year 1 to 3. All right, so create a column for year. You have cash flow. Then we have compounding factor. Compounding factor. To get the compounding factor, it's 1 plus R raised to power n minus 1. Let me rewrite this G. So n minus 1, yeah. Then you have the terminal value. So let's say, for example, you have 1,000 naira for year 1. Sorry, here is 1,000. Here is year 1, year 2, and then year 3. So in year 2, you have 700. In year 4, you have 1,000. Sorry, year 3, you have 1,500. So these are the positive cash flow generated by projects. You know that our assumption is that the modified internal rate of return assume that the cash flow generated by the project can be reinvested at the reinvestment rate or at the company cost of capital. So the assumption is that you want to reinvest the cash flow generated by the project, and that's why you are focusing on the cash inflows alone when you are using terminal value. Okay, so the next thing I want to do is to calculate my compounding factor. So let's say, for example, the company cost of capital is 10%. So here I will just say 1.10. Let me rewrite that. Okay, 1.10. You know, the useful life of this project is 3 years. All right. So n will be 3. So that will be 1.10 raised to power 3 minus 1. When I get to year 2, let me give space. Okay, let me just manage. No, let me give space. That place is too close. Let me write this. So here is year 1, year 2, then year 3. Okay, terminal value will be there. So let's say in year 1, we have cash flow of 1,000. Year 2, cash flow of 500. Then year 3, 1,200. So I need to calculate the compounding factor. To get this, compounding factor is 1 plus r raised to power n minus 1. Okay, let's say the company cost of capital is 10%. For example, I would then say 1.10 raised to power. The useful life is 3 years, raised to power 3 minus 1. Then for year 2 cash flows, so this will be 1.10 raised to power 3 minus year 2. For year 3 cash flows, this will be 1.10 raised to power useful life minus year 3. All right, that's how I'm going to get my compounding factor. Yes, talk to me, Ufoma.
Sir, good
You
day,
raise
sir.
hand.
Yeah, why are we compounding instead of discounting? Is it because we are reinvesting?
Yes, because you want to determine terminal value. You want to know you are investing this money. Your terminal value will include the amount you have invested and the benefits you are going to earn on it. All right. So that's why you are compounding it. Do you get, Ufoma?
Yes, sir. Yes, sir. Thank
All
you.
right. So in this case now, for the year 1 cash flow of 1,000, when I reinvest it, I'm supposed to earn 10%. However, we're now saying that, okay, how many more years can you reinvest this 1,000? The year that the cash flow occur is not part of the year you cannot invest in year 1, for example, because all this cash flow will occur at the end of each year. So the 1,000 is at the end of year 1. So when you now want to reinvest the 1,000 that occurred at the end of year 1, you have 2 more additional years. So you can reinvest this 1,000 for year 2 and then year 3. That's 2 more years. And that's why you can see here that this one is 3 minus 1. 3 minus 1 will give you 2, which means that you can invest this 1,000 for additional 2 years. Again, for the second cash inflow of 500, all right, this 500 occurs at the end of year 2, all right, the 500 occurs at the end of year 2. So you need to ask yourself, how many more years can I reinvest this 500, this 500? So you have only 1 more year because the year 2 is not part of it again. So you can only invest for year 3. So that means only 1 year. And that's why we are saying 3 minus 2 will give you only 1. Okay, this one will be for 2 years. This is for 2 years. This is for 1 year. Then the third cash inflow 1,200. Again, you need to ask, how many more years can you reinvest this 1,200? The 1,200 occur at the end of year 3. How many more years? 0, because 3 minus 3 will give you 0. This will give you 0. Okay? So that's how you are going to determine your compounding factor. So to now get the terminal value, you are supposed to first of all calculate the compounding factor. Then you now multiply with the cash inflow. Let's say, for example, if I bring out my calculator, I can say, for example, 1.1 for the first year cash flow of 1,000. So 1.1 raised to power 2. It's not minus 2. It's not raised to power minus 2. When you do raised to power minus 2, that means you are discounting it. Here we are compounding it. So 1.1 raised to power 2. So on my calculator, I got 1.21. So I would then multiply that 1.21 with 1,000. So that will give me a terminal value of 1,210. So the 210 represent the benefits. What I've invested is 1,000. So you are combining both your investment and the benefits is what it just like you can't well, if you say profitability index, but profitability index is in ratio. So but that's not what we are talking about today. All right. Now, the second one, if I want to calculate for the second cash flows, which is 500, I will say 1.10, then raised to power 1, because I can only reinvest the 500 for additional 1 year. Okay, raised to power 1. So that will still give us 1.1. I will then multiply that 1.1 by 500. Okay. So that will give us 550. So here will be 550. Then the last one, which is year 3 cash flow of 1,200. How many more years? 0 years, because 3 minus 3 will give me 0. This cash flow occur at the end of year 3. I can only reinvest in the for 0 years. So in that case, anything raised to power 0 is equal to 1. Therefore, 1.1 raised to power 0 will give me 1. So when I multiply 1 by 1,200, I will get the same thing as 1,200. Then I will add everything together. That will give me the terminal value. This should give us like a 2,792,960, I think. Yeah, that should give us like 296. So that represents the terminal value. So this is how to calculate terminal value. That's how to calculate terminal value. So after I've gotten the terminal value, I will then go to step 2. Step 2 says I should calculate. Step 2 says you should calculate the present value of negative cash flows. So it is possible that you may have negative cash flows in between years, not only in year 0. All right? Not only in year 0. It is possible that you may have terminal value, a negative cash flow in between years. Say, for example, you have year 1, year 2, year 3, and then year 4. Let's say you also have year 0. In year 0, that's where you have the initial outlay. Let's say initial outlay is 1,000. This one will always be in a negative. Then in year 1, let's say the cash inflow generated by the project in year 1 is 2,000. The cash flow generated by the project in year 2 is 500, uh, 500 negative. Then in year 3 is 1,000 positive. Year 4 is 700 positive. So you see that because this is unconventional cash flow, you have negative and positive cash flow in between the years. Therefore, when you are calculating modified internal rate of return, you will of course, you are only going to select, when you are using terminal value, you select the positive cash flows. You calculate terminal value for the positive cash flow. You calculate for this, you calculate for year 1, year 3, and year 4 only. So when you keep it on one side, when you now want to calculate the present value of negative cash flow, you do for year 0, you also do for year 2. All right, you then add the two of them together. So that's all you are going to do. Then step 3 says you should calculate the modified internal rate of return using the formula. So don't worry, as we proceed, when we begin to solve questions, you'll see how we are going to treat this. But for now, let's continue with the explanation of the concept. All right. So that is how to calculate modified internal rate of return using the terminal value method. So let's talk about the second one, which is using the present value method. How do you calculate modified internal rate of return using the present value method? The present value method is a method that considers both the present, both the the positive cash flows and then the negative cash flows. That it also involves three or four procedures. All right, let's say four procedures, including advice. All right. The step one, let me put it, let me see if I get space here. Let me manage here. Terminal value method. Okay. Sorry, present value. Calculating modified internal rate of return using, let me use here, calculating modified internal rate of return using present value method. Okay. Under this, the first thing you are going to do, step one, is to calculate present value of cash inflows. All right. Calculate present value of positive cash flows. Then step two, you determine present value of negative cash flows separate. Then step three, you calculate, you estimate modified internal rate of return. Okay, using the formula below. Okay, using the formula below. All right. So to get your modified internal rate of return using the present value method, of course, the modified internal rate of return will be calculated as the present value of cash inflow divided by the present value of cash outflow. All right. All of this raised to power 1 over n multiplied by 1. Let me write that. Multiply by 1 plus r, okay? All minus 1. All minus 1. Let me see if I can shift this a little bit. Okay. Multiply by, sorry, that wants to, minus 1, then multiply by 100%. Okay, multiply by 100%. So that will give you modified internal rate of return. So the positive cash inflow is also known as the return phase cash flow. You know, when the company is benefiting, is reaping the benefit from the project, that means the company will be earning return on its investment. So the return phase cash flow is the same thing as present value of cash inflow. But when the company is investing, when the company is spending money on the project, that is the investment phase, the investment phase of the project. So the investment phase, when the company is spending money on the project, is also known as cash outflow. So you can be, examiner can, on the day of your exam, you are going to be given the formula, all right, the formula for calculating modified internal rate of return. You may not see present value of cash inflow and present value of cash out. Once you can see the return phase, cash flow, then you should know that that is the same thing the examiner is talking about. Okay, so this is how to estimate the modified internal rate of return using the present value method. Of course, the fourth step is to advise. So now, what's the decision rule? Let's go back up there. What's the decision rule for modified internal rate of return? Yeah. So the decision rule of modified internal rate of return is the same thing as decision rule under the internal rate of return. For independent projects, you accept if the modified internal rate of return is higher than the company cost of capital. Okay? If your calculated modified internal rate of return is higher than the company cost of capital, then it means that the project is financially viable. But if the modified internal rate of return is lower than the company cost of capital, the project should not be undertaken because it is not financially viable. But um, what if the modified internal rate of return and the cost of capital are the same? Then the company can either accept or reject depending on other qualitative factors. All right. So that is basically how to estimate modified internal rate of return. Like I said, we are going to explain all the concepts once and for all. They will now begin to take examples, illustrations, one after the other. All right. So, but for now, our focus is to explain the concept. So the next thing we want to discuss is project duration. Let's talk about project duration. Once we are done with project duration, we also talk about um, discounted payback period. Then we now move to non-discounted cash flow method. So quickly, let's talk about um, project duration. Okay, I'm not sure project duration is here. Let me see. No. Okay, let me switch. Let me switch to the working notes so that I can use that to explain project duration for you. All right. Okay. Okay, so let's talk about project duration. Project duration. What do you mean by project duration? Now, before I give you the definition, project duration is just like payback period. All right? Okay, it's just like payback period. It can be likened to that, but they are slightly different. It's slightly different from the normal payback period. So uh, let me give you the introduction. Uh, Project duration represent the weighted average. Okay, this represents the weighted average or the average time taken. This represents the average time taken to recoup or recover the amount invested in a project. Okay, that's basically what project duration is all about. Is the average time taken to recoup the amount recover, the amount uh, to recoup the amounts invested in a project. Okay, the project duration can be likened to, let me put it down. Project duration is similar to the normal payback period. Payback period. Except that duration, except that project duration is discounted, or project duration consider time value of money. Okay, so that's basically that. That's the introduction to project duration. How do you then calculate project duration? All right, calculating project duration. Okay, there are basically two methods. Basically, there are two methods of estimating project duration, including one, weighted average method, two, present value method. Okay, so let's talk about each of them and what you need to do. Before that, it's like I'm the only one talking since I don't want to know whether you are with me. Yes. Can you guys can you hear me? Because
No,
I'm
sir.
scared.
I can hear you, sir.
We can hear you,
Uh,
sir.
yes, I want to be sure that I'm not alone. Okay, let's continue then. So let's talk about the weighted average method. Recall, we said that project duration represents the average time taken to recoup the amount invested in a project. So let's say a company invests 100,000 naira in a project. So you want to know, when is it going to take you to recoup your money, to get your money back? How long will it take this project to pay back the money that you have invested? That is project duration. All right. So, and that's what we want to do. I want to show you the method that you can use to determine the project duration. Like I said, we have you have a weighted average method. We also have a present value method. So under the weighted average method, let me bring it out. Weighted average method. Okay. Under this method, the following procedures should be considered. The following procedures, let me just put steps so that you don't, so that will save our time. Steps. Step number one, calculate present value. Okay? Calculate present value for each year. For each year, cash flow. Step two, calculate weighted average. Or let me just, okay, you know how to calculate present value already, but let me just put it there. Let me reframe that. Calculate present value for each year. Okay, let me remove cash flow. Calculate present value for each year by multiplying the cash flows of each year with the discount factor. Okay, with the discount factor. All right, then step 2, you calculate weighted average cash flow. Calculate weighted average cash flow or present value. Weighted average present value, okay, for each year by multiplying the number of years, by multiplying the number of each year with the present value, So that's what you need to do in step 2. Then step 3, you calculate the duration. Calculate project duration. Calculate project duration using the formula below. The good thing about project duration is that when you get to, I think you are already doing bond valuation. Mr. Shiwaju is already taking your bond valuation. Am I correct?
Sure, sir. Yes, sir.
Yes, so you can also use this project duration it's the same format that you're going to use whenever you want to calculate bond duration. Okay, so to now get the project duration, I would then say duration equal to total weights, okay, divided by total present value. Total present value. So that will give the duration. Of course, the duration must be expressed in years. Okay, total weight divided by total present value. All right, so that's all you need to do. Okay, let me just give you the format. Just looking at the time, let me give you the format. So to do this, to carry out all the 3 steps I gave to you above, so let's use this format. Yes, the first one will be year. Just let's forget about description of items. So you put cash flow. Then you have discount factor at whatever percentage. Then you talk about, you are going to calculate present value. Then you determine the weight. So let's say this is A, this is B, this is C, this is D. D is equal to B times C. B times C. Then this is E. E is equal to A multiplied by D. A multiplied by D. That will give you the duration. Sorry, that will give you the weights for each year. So let's say you have year 1, year 2, year 3 for simplicity. So total. So the cash flow for each year, you put it here. The discount factor, you get it and put it there. So the present value, you add everything together. Then the total weight, let me rewrite this. E equal to A times D. So get the total weight. Then you now calculate the duration, which is total weight divided by total present value. So this is how to calculate project duration using the weighted average method. All right, using the weighted average method. Okay, let me reframe this so that I don't repeat formula twice, since I've already written it down there. So let me reframe this. Calculate project duration using the format below. Let me change it like that. Using the format below. It's better. Okay, so let's talk about the second method, which is present value method. Okay. Present value method. So under this method, again, there are three procedures that you are going to carry out. Step one, you calculate present value for each year. Calculate present value for each year, cash flow. Of course, you know how to calculate present value. I just mentioned it in step one, in method one. Then step two, you calculate the proportion of the present value of each year. Calculate or determine the proportion of each year PV to the total present value. That is, divide the present value, divide the present value of each year with the total present value. Okay, that's all you need to do. Then step three, calculate project duration. Calculate project duration by multiplying the number of years, with the proportion of PV of each year. Okay, that's all. That's all you need to do. Let me give you the format once and for all. Okay, to do this, let me say the format below can be used. So anytime you want to calculate project duration. Project duration using the present value method. You can adopt this format. Okay. So you create a column for year, cash flow, present value, then proportion of PV. Then you have duration. You have duration. So I've omitted something. I did not put discount factor. Cash flow, discount factor, then the PV, proportion of PV, then duration. Okay, so let's say this is A, B, C, D equal to B times C, then E, F, F equal to A times E. That's all. Let's say you have year 1, year 2, year 3. Okay, all right. Total. Okay, if possible, you can sum up the total proportion. The total proportion must be equal to 1. Okay then. So for the cash flows, you have to put the cash flow there, discount factor for each year. You multiply the cash flow with the discount factor to get the present value. Now, to get the proportion of PV, to get the proportion of present value, you are supposed to divide the present value of each year with the total present value. You are going to pick the present value of year 1, for example, you divide it with the total present value. So whatever you have, you put the proportion there, put a percentage there. You do the same thing. You pick the present value of year 2, all right? You divide it with the total present value. So you put the proportion percentage there. Do for year 3, divide it by you take the year 3 present value, you divide it with the total present value, you get the proportion. So you can add up the entire the percentage. It must be equal to 1 at the end of the day. So to now get the project duration, just multiply number of years with the proportion that you have determined. All right. So that will give you the project duration. You add up everything. So whatever you have, we give you the duration. That's it. So whether you use present value method or you use weighted average method, you will get the same answer for your project duration. Again, you can also adopt these formats for your bond duration, okay? For the bond analysis and bond value analysis. So when you are calculating bond duration, so you can use this format as well. When you go to the golden book, you will see all of this thing there. Okay, so let's move on. Yeah, we're almost there. What else? What else? Of course, we also have decision rule. But before we talk about decision rule, there are some basic things you need to understand. When you are calculating when you are calculating project duration, you don't include when there's negative cash flow in year 1. The negative cash flow should be ignored. All right, let me put it down. Notes. Notes. Negative. If negative cash flow occurs in year 1, if negative cash flow occurs in year 1, it should be ignored. The negative cash flow, the negative cash flow should be ignored when calculating project duration. Okay, I will explain. Project duration. 2, if negative cash flow occurs in between years, if negative cash flow occurs in between years or after year 1 or after year 1, the negative cash flow should be included. The negative cash flow should be included or considered, should be included in the calculation. Okay, now that's that. So this is what I'm trying to say. Say, for example, the first note above, let me put it this way. For example, say, for example, you have year 1, year 2, year 3, and then year 4, and you are given cash flow that has the following for pattern. In year 1, you have cash flow of 1,000. Year 2, 500. Year 3, 1,000. Year 4, 1,000 or 15. So when you are calculating project duration, you only calculate for year 2, you only consider year 2 to year 3 cash flows where you have positive cash flows. So you are going to ignore the cash flow that arise in year 1, the negative cash flow that arise in year 1, you ignore it. So it will not be part of your calculation. Like for example, in this table now, if the year 1 cash flow is negative, I will not include that year 1. I will only do for year 2 and year 3. If the cash flow occur, if the project has 5 years life and the year 1 cash flow is negative, you will ignore the year 1. So you do for year 2, year 3, year 4, and then year 5. Anytime you have negative cash flows, it should not be included. Anytime you have negative cash flow in year 1 for the project, it should not be included in the calculation of the project duration. But if the negative cash flow arises after the project has generated positive cash flow, then the negative cash flow should be included. For example, now for the second one, for the second note above. So in this case, let's say for example for years, and then let me say cash flow. Let's say in year 1, we also have the same number of years, year 1 to 4. In year 1, the project generated positive cash flow of 2,000. In year 2, negative cash flow of 500. In year 3, 1,000. Year 4, 1, 2. You can see that negative cash flow occurs after the project has generated positive cash flow. So in this case, you are going to include all of them in the calculation of your project duration. So you include all the cash flows. You include all the cash flows. So that's what you need to do, where the negative cash flow is in between years. But in this particular one, whereby negative cash flow occurs in the first year, so you consider only the positive cash flows. In this case, you consider only positive cash flows. Consider only positive cash flows. Okay, cash flows. Uh-huh. So you ignore the negative cash flow in year one. So another student can ask me, what if the the negative cash flow occur more than once after year one? It's still the same thing. Let's say, for example, another example is that I'm coming for you former, hold on. Let's say another example is that let's say you have year, you also have cash flow. Year one, year two, year three, then year four. In year one, you have a positive cash flow of 1,000. In year two, you have negative cash flow of let's say 200. In year three, you have a positive cash flow of 2,000. Then in year four, you have a negative cash flow of 500. So provided the negative cash flow does not occur in year one, so you have to include it. In this case now, you have to include everything. You include all cash flows, okay? Whether positive or negative. So the only thing that will make you to ignore year one cash flow is if that year one cash flow is negative. If negative cash flow occur any other years other than year one, you have to include it. All right. So that's what you need to take into consideration. Yes, Ufoma, you raised hand the other time. Talk to me. How about
And
when
what's
negative cash
the
flow?
reason?
Pardon?
What's the reason? What's the reason behind the year one that has negative? Is there any reason behind this
Year
principle?
one is year one is just when you have negative cash flow in year one, it's like you are spending the money. You are still spending money. So the project has not generated any cash inflow. So it's a cost. All right. So what about
Okay.
Olamide is asking, what about when negative cash flow occur in year one to three? If cash flow occur in year one to three, you cannot you continue until you get positive cash flow. You just ignore year one to three negative cash flow. So until the project begin to get negative cash flow. Okay, Olamide? Yeah.
Sir, I don't understand the answer, sir. So sorry.
Yes, you are asking, what if the project generates negative cash flow from year one to year three? I said you are not going to do it, just ignore the cash flows of negative cash flow of year one to three. You only begin uh, calculating your project's duration from where the project starts generating positive cash flow. So in your own case now, you are talking about if the project generates negative cash flow from year one to three. So just ignore it. All right, you ignore year one to three negative cash flow. If year four you have positive cash flow, then you begin calculating your project duration from the positive cash flow.
Okay, sir.
All right, so yeah. So in this case, the decision rule would be that, of course, you have to benchmark your project duration with the management predetermined duration, because management would have expected that, okay, this is when they intend to recoup the amount invested. All right. So, but if management predetermined duration is not given, then just do your calculation and move on. All right. So project duration is pretty straightforward. We are going to have live question when we begin calculations. So, so that's basically that as far as duration is concerned. Okay. Uh, so I do want to talk about discounted payback period now because I want to take you normal payback period before we talk about discounted payback so that it will be clearer to you. Okay? So if that is the case, this may be where we are going to stop today. In our next class, we are going to start discussion on non-discounted non-discounted cash flow method. So we are going to talk about payback period accounting rate of return, and then we come back to the discounted payback period before we move to relevant cash flow, impact of inflation and taxation. Then I will provide you with the formats. If possible, we may start calculation in our next class. If not, we hold on. So now in our next class, majorly it will be explanation of the concepts for other areas, for the other scope of the topic. Then the last two periods will be for calculation only. All right, will be for calculation. That's what I said. It will take us 1 month to complete the capital budgeting decision. Okay, so let me know if you have any question for me so that we can close the class for today. Any question? Okay, so maybe because there's no calculation for now. All right, then. I want to say thank you to every one of you for waiting behind. So I will see you again next time by the grace of God. Good night. Bye-bye.
Okay, sir.
All right.
Thank you, sir.
All right, you're welcome.
Nice.
All right. Good night.